Hello, welcome to another discussion with the New Jersey Forensic Accountant. Today we're going to discuss how to improve your Cathie Wood's and Jim Cramer's returns by close to 40%. Now, this seems like a kind of a different topic for a forensic accountant, but as forensic accountants, we are often in court asked to testify against and for the IRS, by brokerage firms, individual investors. So we get a lot of knowledge when we do this testimony, and I just want to go over some things that we've learned. So let's start off with Cathie Wood and Jim Cramer, because in 2020, both of them had tremendous returns in the market, and there was a lot of new investors who went into the market for the first time. And you had Cathie Wood, who some of her funds earned over 150%. Can you imagine that for a new investor getting into the market and let's say they made $25,000? It's a lot of money. And the surprising thing is that they don't realize, and right now when I'm doing this tape here is when they're going to start filing their taxes, that they can lose up to 40% in taxes. And if they have short-term capital gains of over 40%. So the first thing as a new investor or someone who's in the market, you should understand what is the difference between investor and a trader. Okay, this is an important difference. A trader is someone whose main source of income is derived from trading stocks and spends most of their working hours honing their craft. Everyone else is called an investor. Now, I realize that when you meet someone, everybody seems to, especially the younger kids, well, yeah, I'm a trader, I'm a day trader, I'm this and that. Well, you may not really be a day trader based on what the IRS requires you to do to consider yourself a day trader. Okay, you may just be an investor. And why is that a problem? Because, for example, where I live in New Jersey, the tax rate is over almost 11%, the highest tax rate in New Jersey, and the highest federal rate is 37%. So if you sell these stocks before a 12-month period, you're going to be subject to those taxes. And that's, 47% in New Jersey, 38%, that's 48%. That's crazy. But if you sell after 12 months, you get what's called capital gains treatments, where the taxes are limited to 15% or 20% plus your state rate. So there's a big difference here, and it's important to understand that. Now, if you sell, and again, here's the rate, 47.75% in my state, depending on where you are. So you may want to understand that, and when you file your taxes or when you make this money, put some of that money away, because you have a partner, a silent partner, which is the U.S. government and your state government. Now, the one thing is if you have losses. Now, hopefully you don't have any losses based on 2020, because it was a pretty good year in the markets. I think the S&P 500 earned over 15%. So, but if you do have losses, let's say you have a $10,000 loss on one stock and you have a $7,000 gain on another. Well, you're not going to pay tax on the first $7,000, right? And the other $3,000 will offset your earned income. Now, if you have a bigger loss, like we see, hundreds of thousands of dollars of losses, and you're an investor, you can't do anything with it. Anything over $3,000 is carried forward up to 8 years. Now, you can offset it against capital gains, but if you don't have any, you're going to lose that. If you're an investor, that is, not a trader. And the other problem I see with a lot of people, they don't realize there's a wash law. Now, what this wash law does is, if you sell a stock, let's say on the 15th of the month, and you have a $40,000 loss, and you're like, I can offset some of my gains with that. But you buy that stock back within a 30-day period, you cannot deduct that loss. Okay, you have to wait 31 days. And a lot of people will sell stock right before December to utilize the losses of a good stock, let's say. They know it's going to go up. And what they want to do is they want to jump right back in. So they sell it on like December 27th, and they buy it in January the next year, trying to use that loss on their tax return. Well, they can't use that loss because it's a wash loss. The IRS disallows it. Not only that stock, but the law specifically states any similar type investment. Okay, so if you sell gold and you buy a gold fund or a gold mine, that loss may not be deductible. Anyway, you really got to think this over and discuss it with your tax guy. But the information from this sale will be reported on a 1099-B. You should know that. Now, the cryptocurrency, which is really growing now, is a little bit different. It's not reported on a 1099B. It's reporting on 8949, and the IRS is really focusing on that. One strategy I want to talk about is so you can avoid all these taxes is a Roth IRA, and we have a whole video on the Roth IRA. Now, if you put one of Cathie Wood's funds in the Roth IRA, you wouldn't pay any taxes if you didn't take the money out. And if you took your initial contribution out, it wouldn't be tax-free. Just the gains would be taxable. So what I tell people, I said, listen, if you're not going to trade too much, you want to just set up a Roth IRA and trade from the Roth, okay? And the great thing with the Roth is once you're over 59 and a half, if you keep it in for 5 years, it's all tax-free, all of it, okay? And we just told you that the rates are close to 50%. Now, you can withdraw earnings and the contributions tax-free after that time. There's other benefits, too, like you can pass it to your children. Lots of great stuff you could do with the Roth. Now, unfortunately, there are some restrictions. Like a Roth is not a regular trading account. You can't trade on margin. Option contracts and shorting stocks may not be allowed. Lots of different stuff there. Generally, you can buy and hold stocks long-term and perform limited trading in the Roth IRA. So what I would say is, if you want to sidestep all this other stuff here and just make a ton of money that's tax-free, build up the Roth, buy the funds in there. Like I said, there was funds last year made 150%, 50%, and it's important to realize you do have a silent partner, the government. If you want to cut them out, this is one of the things you could do. Listen, guys, I hope you enjoyed this video. If you have any questions, leave the comments below, and me or one of my analysts will get back to you. And if you can, subscribe to my YouTube channel. It helps a lot. We do a lot of stuff here that you're never going to hear anywhere else. Thanks a lot.